Something is happening in the global markets right now, and it doesn't make sense. Stocks are going up, the fear index is falling, oil prices are cooling down, and everywhere you look, the same word is being repeated like a signal of relief: ceasefire. For the last 48 hours, markets across the world have been celebrating a temporary pause in tensions between the United States and Iran. Investors are breathing easier. Analysts are calling it stability, and many people are quietly starting to believe that the worst is over. But what if this relief is exactly what makes this moment dangerous? What if this so-called ceasefire is not a solution, but a setup? Because beneath this sudden wave of optimism, something far more serious is unfolding. Something that most people are not seeing yet. The kind of shift that doesn't just move markets for a day or a week, but can reshape the entire financial landscape for the rest of the year. And here's the real question you need to ask yourself right now. Is Wall Street reacting to reality or walking straight into a geopolitical trap? Welcome to Digital Genkari, where we don't just follow the headlines, we decode what's really happening behind them. And today, we're breaking down what I call the ceasefire mirage. Now, before we go deeper, a quick and important note. This video is created for educational and informational purposes only. The analysis presented here is based on publicly available information, market behavior, and expert opinions, and should not be taken as financial or investment advice. Markets involve risk, and you should always do your own research or consult a professional before making any financial decisions. Now, with that said, let's get into what's really happening. At first glance, everything looks positive. Gift Nifty is jumping, global equities are recovering. Oil prices, especially Brent crude, have pulled back from their recent highs. On the surface, it feels like the market is finally catching a break. But markets don't move on reality, they move on expectations. And right now, the expectation being priced in is simple: that the ceasefire will hold, tensions will ease, and the system will return to normal. But here's where things start to break down. Because while the headlines are talking about peace, the underlying structure of the conflict hasn't changed at all. In fact, in some ways, it has become even more fragile. This is not a situation where everything suddenly resets with a handshake. This is a situation where the visible conflict may pause, but the invisible pressure keeps building. And to understand why this rally might be misleading, we need to look at what's happening in a place most investors never think about, but which controls a massive part of the global economy. The Strait of Hormuz, this narrow stretch of water, carries nearly 20% of the world's oil supply. It is not just a shipping route, it is one of the most critical pressure points in the entire global system. And right now, it is anything but stable. Now here's the part most people are missing. On paper, this 2-week ceasefire looks like a breakthrough. Diplomatic talks are happening. There are reports of back-channel negotiations. Signals are coming out suggesting that another round of discussions could be on the way. And for the market, that's enough, because markets don't wait for certainty, they react to hope. The moment traders sense even a temporary pause in conflict, they rush back in. Stocks rise, volatility drops, and suddenly it feels like stability has returned. But hope can be dangerous when it disconnects from reality. Because while the diplomats are talking, the physical situation on the ground, and more importantly on the water, has not improved. The Strait of Hormuz is still under extreme tension. Commercial shipping is still facing disruptions, and the threat level in that region hasn't disappeared. It has simply gone quiet. And quiet is not the same as safe. This is exactly why what we're seeing right now can be described as a ceasefire mirage. It looks like stability from a distance, but the closer you get, the more fragile it becomes. Now, to understand the real risk here, you need to understand something called the geopolitical risk premium. In simple terms, when there's conflict, oil prices usually go up because of fear. And when that conflict cools down, prices are expected to come back down as that fear disappears. That's the traditional logic. But this time, something is different. Because the premium in the market right now is not just about fear, it's about disruption. Even if tensions temporarily ease, the damage to the system doesn't instantly reverse. Supply chains don't magically fix themselves. Shipping routes don't suddenly become normal again. And the backlog that has already built up doesn't just disappear overnight. Think about it like this. If traffic on a highway is blocked for hours, even after the road opens, it takes a long time for everything to flow normally again. That's exactly what's happening in the energy market. There are reports suggesting that global oil supply is already under pressure. Inventories are being drawn down faster than usual, and tankers are still facing delays and uncertainty in one of the most important shipping corridors in the world. So while the market is reacting to the idea of peace, the system is still dealing with the consequences of disruption. And this creates a dangerous mismatch, because prices are adjusting as if the problem is solved, while the reality is that the problem is still unfolding. And whenever markets and reality move in opposite directions, corrections tend to be sharp. But this is still just the surface, because the real risk isn't just about oil prices moving up or down. The real risk is hidden in the cost of moving that oil in the first place. And almost nobody is talking about it. Because even during a ceasefire, the cost of moving energy across the world has quietly changed. And this is something most retail investors never see. You might look at oil prices on your screen and think everything is under control. Maybe prices are stable. Maybe they've even dropped slightly. But what you're not seeing is what's happening behind the scenes. The actual cost of getting that oil from one place to another. Because right now, that cost is rising. Shipping companies are facing higher insurance premiums. Routes are being adjusted to avoid risk zones. Some tankers are waiting longer before even entering critical regions. And in certain cases, additional security measures are being taken just to move through sensitive areas. Now, think about what that means. Even if the price of oil itself doesn't spike dramatically, the cost of transporting it still increases. And that extra cost doesn't disappear. It gets passed on. It gets built into fuel prices, into manufacturing costs, into transportation, and eventually into everything you and I pay for. This is what we can think of as a hidden layer of cost, a kind of invisible fee that sits beneath the surface of the market. And this is exactly why the current optimism can be misleading, because the market is reacting to what is visible while ignoring what is quietly building underneath. Now let's bring this closer to home. For a country like India, this situation becomes even more important. India imports a large portion of its energy needs. That means any increase in the real cost of oil, even if it's not immediately obvious in global prices, can slowly put pressure on the economy. It can affect inflation, it can impact currency stability, and it can influence everything from fuel prices to everyday goods. And this is where the situation becomes bigger than just markets. Because energy doesn't just power industries, it powers entire economies. And when the cost of energy becomes uncertain, everything connected to it becomes unstable. But it doesn't stop there. Because alongside energy, there are other critical supply chains that depend on the same regions and the same stability. Experts have been pointing out that disruptions in this area could also impact materials that are essential for agriculture and technology. Things like fertilizers, which are crucial for food production, and gases used in advanced manufacturing, which are critical for industries like semiconductors. Now, imagine a scenario where these supply chains get affected at the same time. You don't just get higher fuel prices, you start seeing pressure on food systems and technology production as well. And that's when a localized conflict begins to feel like a global problem. This is why the idea of a simple pause in tensions can be dangerous, because it creates a sense of calm, while the structural risks are still very much present. And when people feel calm, they take more risk, they invest more aggressively, they assume the worst is over, and they position themselves based on optimism. But if that optimism is built on incomplete information, the consequences can be sharp and fast. Because markets don't warn before they move. They adjust suddenly. And when they do, the biggest impact is usually felt by those who were the most confident just moments before. Because as we move closer to the next few days, everything starts to narrow down to one critical moment: the deadline. Right now, the entire market is quietly leaning on one assumption: that this ceasefire will hold, or at least be extended, that negotiations will continue, that tensions will remain controlled. In other words, the market is pricing in a near-perfect outcome, but history has shown something very clearly. When expectations become too perfect, reality doesn't need to collapse completely to cause damage. It just needs to disappoint. And in a situation like this, where multiple global forces are colliding, disappointment can happen very quickly. Because what we're really looking at here is not just a ceasefire, but a complex power struggle. On one side, there's pressure to stabilize markets, control energy prices, and maintain global confidence. On the other side, there are deeper strategic goals, long-term positioning, and decisions that go far beyond short-term market reactions. And when these forces clash, markets can become unpredictable. You might see calm one moment and sharp movement the next. This is what makes the current situation feel stable on the surface, but highly sensitive underneath, almost like a tightly coiled spring. And the tighter it gets, the stronger the eventual move. Now, this doesn't mean that a negative outcome is guaranteed. The ceasefire could very well be extended. Negotiations could progress. Markets could continue to move upward for some time. But the key point is this: the risk has not disappeared. It has simply changed form. And this is where most people make a critical mistake. They assume that because volatility has dropped, danger has passed. But in reality, low volatility in uncertain situations can sometimes be a warning sign, not a comfort signal. It often means the market is underestimating something. So what does all of this mean for you? It means this is not a time to blindly follow the crowd. It's a time to stay aware, to question what you're seeing, to understand that behind every green chart, there may be factors that haven't been fully priced in yet. Because the biggest moves in the market rarely happen when everyone is prepared. They happen when most people are looking in the wrong direction. And right now, a lot of attention is focused on the idea of peace, but not enough attention is being given to the underlying pressure that still exists. So as we approach this critical window, keep your focus not just on headlines, but on what's happening beneath them. Watch how energy moves. Watch how supply chains respond. Watch how quickly sentiment shifts. Because the difference between reacting late and staying ahead can define outcomes for months to come. In the end, the ceasefire mirage is not about whether peace happens or not. It's about perception. It's about understanding that sometimes what looks stable is only temporarily calm, and those who recognize that early are the ones who stay one step ahead. If you found this breakdown valuable, make sure to stay connected with Digital Jankari for more deep insights into the forces shaping global markets. Because in a world where information moves fast, clarity becomes your biggest advantage. And right now, clarity matters more than ever.